All right, let's dive in. Today, we're talking about one of the most popular, most powerful tools in any trader's toolkit, the MACD. Now, that stands for Moving Average Convergence Divergence, but don't worry about the name. We're going to break down exactly how this thing helps you see what's really happening with a stock's momentum.
I mean, that's the big question, isn't it? In a market that moves so fast, how do you get a heads up that a trend is losing steam? How do you spot the moment when a downward slide might be about to reverse and head back up? It's all about looking for clues hidden in the price charts. And, well, that's exactly where the MACD comes in. It is one of the most trusted tools for finding those exact clues. It's built to do three things, and do them really, really well. Show you which way the trend is going, tell you how strong that trend is, and give you a little nudge when it might be time to buy or sell.
So, here's the game plan. We're going to cover what the MACD actually is, break it down into its three simple parts, learn how to read the signals it gives us, see how it stacks up against another popular tool, and then we'll wrap up with the really important stuff, the key takeaways, and a few words of caution.
Okay, so let's get right into it. What exactly is this indicator? To really get a feel for how it works, you got to know a little bit about where it came from and what it was designed to do in the first place.
So this tool isn't some newfangled invention. It was actually developed way back in the 1970s by a guy named Gerald Appel. And it has stuck around for decades for a very simple reason. It just works. All it does is show the relationship between two different moving averages of a price. You can almost think of it like a tug-of-war between the short-term trend and the long-term trend. The MACD just gives you a visual of who's winning that fight.
Now I get it. The first time you add the MACD to a chart, it can look, well, a little chaotic. You've got all these lines and bars, and it's not immediately obvious what's going on. But trust me, it's actually made of just three simple parts, and once you see how they work together, the whole thing just clicks.
And it's these three elements, all calculated from the same price data, that paint such a clear picture of what the market is doing.
First up, you have the MACD line itself. This is really the engine of the whole indicator. All it is the difference between two moving averages, a short-term one and a long-term one. These are called exponential moving averages, or EMAs, which just means they put more weight on the most recent prices. You subtract the long one from the short one, and boom, you get the MACD line. This is your fast line.
Okay, so you've got this fast-moving MACD line. Now you need something to compare it against, right? That's where the signal line comes in. The signal line is just another moving average, but it's an average of the MACD line itself. This smooths everything out and gives us a baseline, a slower line. And the magic happens when our fast line crosses over this slow line. That interaction is what we're watching for.
And last but definitely not least is the histogram. This, for me, is where the MACD really shines. The histogram is literally just a bar chart that shows you the distance between the MACD line and the signal line. When the bars get bigger, it means the two lines are moving farther apart and momentum is picking up. When the bars get smaller, the lines are coming together and momentum is fading. It's a fantastic at-a-glance visual of the trend's strength.
All right, so now we know the parts. We've got the fast line, the slow line, and the histogram that measures the distance between them. So what? How do we actually turn all of that into a signal we can use? Well, let's look at the key patterns that traders are constantly on the lookout for.
It really comes down to three main types of signals. First, you have crossovers, which are the most common and straightforward. Then there's something called divergence, which is a little more advanced but super powerful. And finally, you can look at really sharp moves, which can sometimes tell you if a stock is getting overbought or oversold.
So the most basic signal is the crossover. It's just like it sounds. When the fast MACD line crosses up and over the slower signal line, that's considered a bullish signal. It suggests that momentum is shifting to the upside. And you guessed it, when the MACD line crosses down below the signal line, that's a bearish signal, a sign that downward momentum is taking over.
Now divergence, this is a more subtle signal, but man can it be powerful. Divergence happens when the price chart is telling you one story, but the MACD indicator is telling you a completely different one. For instance, say the stock's price hits a new low, but the MACD doesn't. The MACD actually makes a higher low. That disagreement is called a bullish divergence, and it's a huge clue that the downward momentum is running out of gas.
Now here's something that is absolutely crucial to remember. No single indicator is perfect. You should never, ever rely on just one tool. To really use the MACD well, you need to understand how it fits in with other indicators, and a really common one to pair it with is the Relative Strength Index, or the RSI.
Think of the MACD and the RSI as partners. They're both looking at momentum, but they're doing it from totally different angles. The MACD is all about the relationship between two trends. The RSI, on the other hand, measures the speed and magnitude of recent price changes to tell you if a stock is overbought or oversold. Using them together gives you a much richer, more complete picture of what's going on.
Okay, let's be real for a second. As great as the MACD is, it is not a magic crystal ball. It has its weaknesses, and knowing what they are is what really separates the pros from the amateurs.
You've got to remember three things. First, it can totally give you false signals, especially when a stock is just chopping around sideways with no real trend. Second, it's a lagging indicator. Because it's based on past prices, it's confirming a trend that's already underway. It's not predicting the future. And that leads to the final most important rule. Never, ever use it by itself. Always look for confirmation from other indicators or chart patterns.
So let's wrap this all up. The MACD shows you the relationship between a short-term and a long-term trend. It's made up of three things: the MACD line, the signal line, and the histogram. Its bread and butter signals are crossovers and divergences. And remember, it's a fantastic tool for measuring momentum, but it's always best when you use it as part of a bigger analytical strategy. And I'll just leave you with this final thought to chew on. We call the MACD a lagging indicator, right? Because it's based on past data. But what about the histogram? If you're watching those bars and you see them start to shrink, you're seeing momentum fade in real time, often before the lines even think about crossing. So is it possible that the histogram gives us a little leading hint of what's just around the corner? Just something to think about.